Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst stock. Today we're looking at Canopy growth.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast.
We do read them all.
And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis. We're talking about a company that, has been through a lot, a major Canadian LP that really spent the last few years on a painful but very necessary cleanup.
Right, a total reset.
Exactly. And the story now is moving from, let's say, stabilization to a genuine inflection point. We're actually seeing it in the numbers now.
And that difference between just stabilizing and actually inflecting, that's everything, isn't it? For years, the story was just burning cash.
It was.
So how do we know this is the real deal, that they've actually found the bottom?
Well, we can pinpoint it to fiscal year 2025. If you strip out all the businesses they sold off, the non-core assets, their net revenue decline was only about 1%.
Just 1%, after years of huge drops.
Yeah. That single digit after everything, that was the signal. It told us the business had finally stopped shrinking.
Okay, so the foundation is set. Now we're seeing the first few floors of the building go up. How strong is this new growth?
It's surprisingly strong. The latest Q2 results for fiscal 26, consolidated net revenue was up 6% year over year. That's about $67 million.
Okay, but what about the core business, the part that really matters?
That's the real story. The core cannabis net revenue jumped 12% year over year to $51 million. This confirms it. After all that pain, they're back to growing the business that matters.
12% is a solid number, but not all revenue is the same. Let's unpack where those gains are coming from. The Canadian market is just brutally competitive.
It is. The strength is really coming from two places, and one of them is their Canadian medical cannabis segment, which, people often overlook.
Higher margin business, right?
Much higher margin. And it grew 17% year over year in Q2. This is quality growth, too. It's driven by a higher average order value and more patients. It's a really durable foundation for them.
That makes sense. Medical patients are stickier. But what about the recreational side, the adult use market? Are they finally starting to win there?
They are. The execution has gotten so much better. Canada adult use revenue grew 30% year over year in Q2.
30%, wow.
Yeah. And this isn't just the industry lifting all boats. This is them gaining traction in their home market because they finally focused their strategy.
Okay, so top-line growth is back. That's step one. But for years, growth didn't matter because the margins were awful. So let's talk about the path to profitability.
Absolutely. The margin story is, it's where you see the operating leverage really start to kick in. In fiscal 25, their consolidated gross margin expanded by 300 basis points.
Let's hold on. For everyone listening, 300 basis points, what does that mean in simple terms?
Good question. It's just 3 percentage points. So say from 27% to 30% gross margin. But the real jump happened in this last quarter.
Okay, so what do we see in Q2?
In Q2, the consolidated gross margin hit 33%. That's an 800 basis point jump from the quarter before. An 8 percentage point improvement.
That is a massive leap.
It's the kind of thing you see when a company finally gets its costs under control and starts using its assets efficiently.
And it's not all just from, the price of cannabis flower going up and down. I think the Storz & Bickel hardware business is really interesting here.
That's their ancillary moat, as some analysts call it. It gives them some protection from the commodity price wars.
And how are the margins there?
Storz & Bickel hit a 38% gross margin in Q2. Just fantastic. They finally cycled through all the old inventory they had to write down.
So rising revenue, better margins, it all sounds good. The losses must be getting smaller then. What about the expense side of things?
The improvement is undeniable. Their operating loss improved by 63% year over year in Q2. And crucially, SG&A expenses, that's all your corporate overhead, fell 13%.
So they are actually doing more with less.
Demonstrably so. And this is where it gets really interesting for their financial health.
Right, because it's all about getting to positive cash flow. How close are they?
Focus on adjusted EBITDA loss. In Q2, it shrank to only $3 million. A year ago, it was $6 million.
Only $3 million. That's basically break even for a company this size.
It is. You're right on the cusp. It makes getting to positive adjusted EBITDA not just possible, but, highly credible. They locked in $21 million in annualized savings. That's permanent.
So hitting positive EBITDA next quarter is a real possibility. That would completely change the story.
It really would. It moves them from a survival story to a growth story.
And all this cleanup work leads us to the balance sheet. They had to fix the past excesses, right? Let's talk about the debt.
This might be the most impressive part. The aggressive deleveraging. They have cut their total debt by 49%. It went from C $597 million down to C $304 million.
49%. Almost half their debt is just gone. In this interest rate environment, that is a huge move.
It's a game changer. It lowers their interest payments every single quarter, and maybe more importantly, it just reduces that refinancing risk that hangs over the whole sector.
And what does their liquidity look like now?
Very strong. They have a current ratio of about 5.5x and around US $245 million in cash. Now, to be clear, free cash flow is still negative.
Okay.
It was negative C $176 million last fiscal year. But even that is getting better. It improved 24% year over year. The trend is firmly in the right direction.
And the market is starting to notice. They had a big earnings beat. On November 6th, they reported an EPS of -1 cent versus an expected -11 cents.
Yeah, that's the kind of surprise that makes people sit up and take notice. It just signals that the cleanup is happening way faster than anyone on the outside predicted.
Okay, so the foundation is solid, margins are up, the balance sheet is clean, but all of this is really just setting the stage for the big one, right? The massive external catalyst.
That's right. The whole high-risk, high-reward part of this story is all about one thing: the potential for U.S. federal rescheduling of marijuana to Schedule 3.
Let's break that down. Why is moving from Schedule 1 to Schedule 3 such a big deal financially?
It all comes down to a single, really punishing piece of the tax code called 280E.
Right.
Under Schedule 1, cannabis companies can't deduct normal business expenses, things like rent, payroll, all the normal stuff. They get taxed on their gross profit, not their net profit.
So they're paying taxes on money they never actually made. It can lead to effective tax rates of, what, 70, 80%?
Exactly. It makes normal profitability almost impossible. Moving to Schedule 3 gets rid of 280E for U.S. businesses instantly.
And that would unlock how much value?
Potentially hundreds of millions of dollars in net income across the U.S. assets they plan to acquire. It just normalizes everything.
And this is where their Canopy USA ecosystem comes into play. They didn't wait for this to happen.
That's their ace in the hole. They pre-built the entire legal structure to consolidate their U.S. assets acreage, WANA, the second the rules change. They are set up to be a first mover.
So no scrambling to do M&A after the fact. They can just flip a switch.
Pretty much. Yeah. They did all the hard work up front so they could step right into a liberalized U.S. market.
We've seen how sensitive the stock is to this. It jumped 54% in one day just on speculation.
And another 32% intraday more recently. That volatility tells you this isn't about fundamentals anymore. It's a policy play. The market is betting on a massive re-rating.
Okay, we've laid out the bull case pretty clearly. But we have to balance the books. What's the biggest risk here? What's the bear case?
The biggest risk is the same thing driving the upside. The policy. The whole bullish story depends on rescheduling actually happening. And we have to stress the White House has said no final decision has been made.
So if it gets delayed or blocked, all this momentum could reverse very, very quickly.
Absolutely. The stock could face a sharp compression. And, the underlying financial risk is still there. They still have negative net income and negative free cash flow. If growth stalls, dilution is still a possibility.
And there's also the execution risk from those class action lawsuits. That's still hanging over them.
It is. It's a reminder that even if the strategy is right, the day-to-day execution has to be perfect. Those lawsuits cover a period from mid-2024 to early 2025 and allege misrepresentations about costs. It's a detail, but an important one.
But the counterpoint, I guess, is that so much of this risk was already priced in after years of underperformance, right?
That's the argument, yeah. The bar was incredibly low. And this management team has shown they can execute. The 49% debt reduction is proof. They've de-risked the business internally before the external catalyst hits.
So looking ahead, what's on the catalyst calendar? What should we be watching for?
The very next earnings print. They were at a $3 million adjusted EBIT bore loss last quarter. The next report could realistically hit positive adjusted EBITDA.
That would be the big one. A huge psychological and fundamental milestone.
It would. And on the product side, watch the new launches, like their new vapes in Canada. They need those higher margin products to work. But really, it's all about policy. Any concrete news out of the U.S. will move this stock more than anything else.
So it's this really asymmetric opportunity. They did the hard work, cleaning the balance sheet, fixing the margins before the big catalyst lands.
Exactly. The opportunity is that they're not just a speculative bet anymore. They're a fundamentally improving company that happens to have this massive potential tailwind. If policy goes their way, the upside is just substantial.
A very clear framework. So the question to think about is this. If the White House does reschedule, how fast will the market price in the total elimination of 280E? And what happens if this isn't just delayed but gets punted entirely past the next election?
Something to keep in mind as you assess the risk.
If you want to keep up with crucial stock analysis like this, make sure you join our community and subscribe right now. We'll be back tomorrow with another talk into the world of smart wealth.